या कुन्देन्दु तुषारहारधवला या शुभ्रवस्त्रावृता या वीणावरदण्डमण्डितकरा या श्वेतपद्मासना या ब्रह्माच्युतशङ्करप्रभृतिभिः देवैः सदा वन्दिता सा मां पातु सरस्वती भगवती निःशेषजाड्यापहा। शुक्लां ब्रह्मविचारसारपरमा आद्यां जगद्व्यापिनीं वीणापुस्तकधारिणीम् अभयदां जाड्यान्धकारापहाम्। हस्ते स्फाटिकमालिकां विदधतीं पद्मासने संस्थितां वन्दे तां परमेश्वरीं भगवतीं बुद्धिप्रदां शारदाम्।
Good morning, friends. Wish you all a very happy new year. And this is the first webinar we are having in the new year 2022, and on a very current topic. Because on 31st of December, after 31st December, the use of LIBOR as an international benchmark is being discontinued. Saturday and Sunday today, foreign exchange market is closed. Tomorrow, foreign exchange market will open, and before that, we have this session on bye-bye LIBOR. Our speaker for today, Mr. Hargobind Sachdev. He is a very senior banker, having long experience of almost 4 decades, and he has worked in various capacities and in a large variety of departments. He has specialization in credit, foreign exchange, vigilance, monitoring and appraisal of corporate loans, MSME credit, gold loans, agriculture loans, NRI business, anything you name under the sun, he knows about it. In the field of banking, of course. And he was heading the central desk of Central European Credit Desk of State Bank of India, which was covering 15 countries of Central Europe. And he has, as I said, he has a large number of subjects in which he has interest, but I am sure, having worked over there, this foreign exchange part must be very close to his heart. And that is why he himself sent a message to me that I want to take a webinar on this. And seeing the importance of the topic and the latest thing which was happening there, I immediately agreed to him, and we have this session today. So I'll not be taking much of time and hand over to Mr. Sachdev, so he can start with his presentation, and I'm sure you will all enjoy the presentation very much. Over to Mr. Sachdev.
Sir, is the PPT visible?
Yes, it's perfectly visible. You can start, sir.
नमस्कार, नववर्ष में आप सबका इस बहुत ही पावन एलीट बैंकर्स क्लब फोरम पे स्वागत है। परमपिता परमेश्वर आप सबको सुखी रखें, आपका परिवार स्वस्थ रहे और प्रगति करे, एलीट बैंकर्स की इस भावना के साथ आपसे आज्ञा चाहता हूं कि आज का कार्यक्रम शुरू किया जाए. Worthy colleagues, it's a great honor interacting with you on this Elite Bankers Club forum. I'm thankful to Mr. Mohan for giving me an opportunity at the beginning of the year for this latest development which has happened in international finance market, which will impact almost all countries, because world has become a village now and every country imports or exports something or the other to meet its foreign exchange gaps and various other requirements for various factories which are required for the niche markets in respective countries. I will only say to each one of you while paying my respects that Ana Tera Mubarak, तशरीफ लाने वाले, खुशियां मना रहे हैं तुम सबको बुलाने वाले. Welcome friends, we begin the LIBOR buy seminar today. As you know, LIBOR is London Interbank Offered Rate, and it is one of the most used benchmark interest rate in international trade world over. Initially, it started as a lending rate between the leading banks in London market. Like we have in our call money market, there is a rate in Mumbai. So banks were initially using this rate to lend to each other whenever they were deficit in funding. Later on, this became such an important rate, benchmark rate, that all the lendings worldwide, including the credit card lending, corporate lending, and derivatives, everything got quoted in this LIBOR rate. But suddenly, withdrawal of this LIBOR is creating tensions worldwide. What has happened is that even though LIBOR was decided to be dispensed with in 2017 and 4 years were given, but international market is so vibrant that even today, 3.5 trillion worth of contracts and derivatives are still written in LIBOR. World has spent millions of dollars in rewriting their contracts, but still large number of contracts are there. So even though it has been discontinued from 31st of December 2021, but the contracts which are written in LIBOR will remain valid up to 30th June 2023, because the number of contracts is so much that every lender or every borrower will have to honor this LIBOR contract, because suddenly they cannot be overnight changed into SOFR. Irony is that SOFR has its own limitations. It is still evolving, and not many people are very savvy to understand the implications of SOFR. Unfortunately, SOFR is written in only US dollar. Now, earlier LIBOR was written and used in 5 currencies. Now, because it is only in US dollars, so countries like England, Switzerland, Hong Kong, Singapore, Australia, those who had a affinity for LIBOR, they are rudderless. They are evolving their own benchmark rates. So there is a lot of confusion, friends. So before we really delve into the realms of LIBOR, let us start with a small story. All of you know that Mount Everest, was the very, very fascinated peak, and everybody wanted to reach that pinnacle of Mount Everest. But then large number of people tried and failed, but they could not. And ultimately, Edmund Hillary, he decided that he will scale this mountain. His sister borrowed 8,000 New Zealand dollars from Christchurch Bank, and gave that money to her brother and said, go to Nepal and be the first human being to scale the Mount Everest. He came to Nepal, he was acclimatizing, trying to, throw pickaxes, ladders, ropes, mounting. And then, suddenly one day he fell down about 35 feet and broke his back. He, used satellite phone and told his sister that probably he will also not be able to scale mountain because he has damaged his body. Sister motivated him and said that you please, take some injections, some medicines, these things do happen, but you please actualize my dream of scaling the Mount Everest. So one day he was taking medication and taking a certificate from doctor that he is fit. Suddenly he found that he was declared unfit and he was very, very sad. In the night, he was peeping out of window and he saw Mount Everest shining below moon. And, tears started rolling down his eyes. He was very sad that he could not scale the Mount Everest. But suddenly something happened inside his body. And he ran to his bedroom, put his head in the bed and started weeping loudly. And then, he got some energy from inside and came running out to the Mount Everest side and shouted, "Hey, Mount Everest, your height is only 29,029 feet. I am a human being. My height is only 6.5 feet, but because I am a human being, I will increase my height to thousands of feet. I am coming." And within next 15 days, friends, he went up and he was the first person along with Sherpa Tenzing Norgay to scale Mount Everest. So even though this LIBOR mess, which has suddenly, become so big that 3.5 trillion worth of transactions are pending, is confronting us, but we know that financial world operatives, the bankers are very efficient, and like Edmund Hillary scaled the Mount Everest, all of us also will find out a way that the cost of funding and financing to the customer remains low. We enter into new contracts as early as possible and be winners. Friends, the session agenda is bye-bye LIBOR, welcome SOFR, evolution of banking. I will also be taking you to how banking evolved, how the financial markets evolved, what exactly is the concept of interest, and what is compounding interest, what are repurchase agreements, what are repos, reverse repo. We'll also delve into Indian market and find out what is MCLR and EBLR. And then we will spend most of our time discussing LIBOR, its advantages, which we might lose, the disadvantages, which will go away. And also we will find the new substitutes for LIBOR. And we will also find the positives and negatives of this SOFR and LIBOR. Friends, we'll now begin with LIBOR. It is a history now. LIBOR is a rate of interest at which major global banks lend to one another. It is used as a reference rate for setting the interest rate of government bonds, corporate loans, debt instruments, mortgages, even credit card payments, and most of the derivatives. The rate is calculated as an average of interest rate estimated. Here, the word estimated is very crucial to understand the logic behind removal of LIBOR. It is based on estimated, which are those estimates are submitted by leading banks in London. The estimates of leading banks are based on the assumptions of what rate they would be charged if they were to borrow from market. Due to unfair style of fixing the rate of few greedy bankers who gave false estimates, LIBOR ceased to exist. Friends, there are components, as all of you know, there are components in MCLR when we quote MCLR in Indian scenario. And the components are basically four, that is the marginal cost of fund, the cost of CRR, tenure premium, and operating costs. So similarly, in LIBOR, the estimates were done on what will happen to international market, oil prices, dollar, gold. So those estimates in coming few days were taken into account. The risk premium was added, the profit was added, and all this were, asked from leading banks in the London market, and then a LIBOR was quoted. So it is basically a rate which was based on what will happen in future. Now, when we come to SOFR, we'll find that SOFR is based on observable transactions which have happened in past. If that is secure, this was based on hypothesis. So that is why LIBOR has gone. And because it was based on hypothesis and anticipation and estimations, there were opportunities available for bankers to quote higher rate, put some extra premium. And that is how they manipulated the market. And ultimately, some of the bankers, unfortunately, had to be arrested for defrauding the international world by quoting unnecessarily high prices of LIBOR. Now, LIBOR is being removed by SOFR. More than 400 trillion worth of international debt contracts, they are still operative. Now the number has come down to 350 trillion because last month, large number of banks, they have moved, because our RBI is also insisting that most of our leading banks like IBI, ICICI, SBI, HDFC, and Axis, they have to turn away from LIBOR. So large number of Indian contracts have also been rewritten in SOFR. Despite knowing that LIBOR will close on 31/12, many banks have been still writing loan contracts in LIBOR because they have no other reference rate which is adopted by their banks so far. As I submitted, LIBOR was estimate based. It is being replaced by a transaction based SOFR rate index. It is most likely to be substituted by SOFR. In fact, the American authorities, the American regulator has already told that SOFR is going to be the index for the future. But as I submitted, the irony is that it is still only quoted in dollars, and other markets are waiting. London market, being the biggest, is also using a sterling overnight index average, that is SONIA, as an alternate to LIBOR, because SOFR is still not very much functional in sterling. The uniformity in quoting international rates has suddenly evaporated. And that is why this seminar, because we want to generate thought-provoking ideas in most of the participants who are very valuable bankers, to find out how soon we can come out of LIBOR syndrome and start giving better rates to the customers. We'll briefly go back, friends, to very interesting evolution of banking. Banking has been an integral part of life. Without bank, there is no life, we have understood. And, if you go to the history of banking, you'll find that as empires expanded, the concept of collection centers evolved. The collection centers were centers where the Rajas, the kings, used to collect taxes, and then they used to distribute wealth to the poor and destitute. Now, how it was done? There were no currency notes, mostly precious metals, converted into coins of gold and silver were issued. And temples were the earliest banks. It's very ironic, but the amount of respect which each banker today draws has actually come out of this fact that temples were the earliest banks, as the same were headed by priests whom king and the commoner trusted. The priests were always trusted by both common man and the king. And what used to happen was that there were no steel or safes or almirahs or residential security. So people, who had coins, they used to keep those coins in the custody of pujari and the priest. And then later on, when somebody needed, those coins for buying goods or paying debts or taxes to the king, then those coins used to be taken away from the priest by that person and then returned with that coin plus additional coin of a silver in the terms in the shape of interest. So this third party operation of somebody's wealth for earning some extra interest laid the foundation of what is called banking today. And that is why bankers are worshipped as priests. Even today, people will not keep their money with their family or brothers even, but they will keep their money, hardened money, in banks. That is the amount of trust banking has. And that is what was breached by the banks in London market, which has resulted in removal of LIBOR. We have to also go into the history of interest. What exactly is interest? According to historian Paul Johnson, the lending of food money, which was a commonplace in Middle Eastern civilizations as early as 5000 BC. The argument that the acquired seeds and animal could reproduce themselves were used to justify interest. What was happening was people used to buy animals and some seeds for growing crop. So for that they were borrowing. Since these assets which they were acquiring out of the money were yielding some good results, some benefits for the beneficiary, so something was taken in return by those who were lending. That was called as interest. The first written evidence of compound interest dates roughly to 2400 BC. And at that time, it is reported that interest rate were very high to the extent of 20%. And the compound interest, was charged because at that time, massive urbanization was happening and funds were needed. In the medieval economy, loans were entirely a consequence of necessity. Like suppose somebody's house has got fire or harvest has destroyed. So for those occasions, people were not feeling low to borrow. It was respectful to borrow in such emergencies, and it was also justified because he is being helped in this emergency, so interest has to be paid. In the Renaissance area, when the civilization further developed, greater mobility of people facilitated an increase in commerce, and appearance of appropriate conditions evolved for entrepreneurs. So slowly, when the civilization evolved, the entrepreneurs started taking loans for producing goods. So there also the interest was charged. Given that borrowed money was no longer strictly for consumption, but for production as well, interest was no longer viewed as a taboo. It became a practice. The first attempt in official banking is not very, very old when interest was charged. The first bank to charge interest was Banque de France in 1847, about 100 years before we became independent. In economics, the rate of interest is actually the price of credit. It plays the role of servicing the cost of capital. In a free market economy, interest rates are subject to levies, supply, and they depend on supply and demand of money required in the industry. The concept of interest actually in finance and economy is payment from a borrower or from a deposit taking financial institution to a lender. It is distinct from fee. There is a difference between interest and fee. It is distinct from fee, which the borrower may pay the lender or some third party. It is also distinct from dividend, which is paid by a company to its shareholders from its profit or reserves. Interest differs from profit in that interest is received by lender. This is a very important difference. Interest is always received by a lender, whereas the profit is received by the owner of the asset. The rate of interest is equal to the interest amount paid or received over a particular period divided by the principal sum borrowed. This is the basic economics of how to calculate interest. Now, because this interest factor became part of economic life and people said there is nothing wrong in helping people in destitute who need money desperately, whether for personal consumption or for industrial development. So that led to what is now a big market, perhaps the biggest market in the world, which is called as the financial market. Financial markets are places that provide an avenue for sale and purchase of assets such as bonds, stocks, forex, derivatives, metals. Financial market is a place in which people trade financial securities and derivatives. Because of the size and the number of participants, the transaction cost is low. That is why financial markets are evolving. Today we have seen we sell our shares, without incurring much cost, at the flick of a button on a computer. So that is the beauty of financial market. It is very transparent. It is very low as far as cost of transaction is concerned. And it has integrity. Settlements are done within the described time. If it is T+1 or even T or T+2, those commitments are continuously honored. Securities which can be traded are stocks and bonds, raw material, precious metals. And a bank uses money of depositors to loan to organization and charges an interest fee. Depositors also earn interest. Therefore, a bank serves as a financial market. The nearest financial market of which we are all part and member is a bank, because it benefits both the depositors as well as debtors. So people deposit and borrowers take away money from here. So it is one of the most evolved, disciplined, regulated, controlled financial market. And they are opening public savings to individuals and companies that need a home loan, student loan, or business loan. Few more slides on interest. Then we will come to the various types of interest, including LIBOR. Now, fund mobilization and liquidity is enabled by financial markets by creating an ambience for availability of funds from domestic as well as non-resident people. See, banks are basically aggregators. I have a daughter to marry off, so I will keep on saving for, say, 12, 13 years. But somebody wants a car, then he will take away that money which I have deposited. But banks will protect my money and start earning interest from him and run their operations. Funds mobilized through banks, mutual funds, NBFCs can be sourced for project funding. Individuals seeking to liquidate FDRs, equity, bonds can easily raise liquidity in financial market. It is very liquid, and financial markets provide opportunity to buy and sell investments as per the need and the timing of the entities. And market conditions determine interest rate. If liquidity is good, interest rates will go down. If liquidity is tight and a lot of people will be chasing the small amount of corpus of money, then interest rate will go up. Price determination and easy access is also a feature of financial markets, which perform function of price discovery of financial instruments. Though it's common intelligence of millions of participants, it reacts to economic developments that can impact interest rates positively or adversely. Being easily accessible, financial market attracts millions of investors every day, and they do it virtually without leaving their desk. The settlement processes are mostly straight-through process with money flowing seamlessly across country. This is all which has happened over the years, and then ultimately the market became so sophisticated that they started creating benchmark interest rates, which we will now go to. Now, interest is actually a very powerful tool of monetary policy also. On this Elite Bankers Forum, we are always, inviting very senior retired bankers, including few chairmen, who discuss monetary policy periodically. Now, interest rate is the major tool to actually implement the monetary policy. Money market facilitate short-term borrowing in instruments like commercial papers, certificate of deposits, and treasury bills. It also enables short-term lending like trade credit. Usually the assets are held for short terms, not exceeding 1 year. The market enables banks to borrow for overnight cash flow mismatches for meeting adverse clearing or SLR requirement on reporting Fridays. Friends, now we come to the repo rates, which are, regulator described rates where which actually will be, when we proceed further, basis of introduction of SOFR and removal of LIBOR. Repo rate is the rate at which Reserve Bank of India in India, or any regulator, whether it is Fed Reserve or it is the regulator Bundesbank in Germany or England. So repo rate is the rate at which the regulator lends money to commercial banks or financial institutions against government securities. See, here it is very important. It is against government security. So it is a secured rate. And when you come to SOFR and find the difference between LIBOR and SOFR, you will find that this is the difference, that repo rates are secured rates. They are against government securities. The current repo rate, as you all know, is 4.25% in India. Changes in repo rate affect the flow of money in the market. That is what the monetary policy is all about. Repo rate is set by the Reserve Bank Monetary Policy Committee. RBI adjusts this rate in order to keep inflation within its 3 to 6% target range. There is a mandate given to RBI to monitor inflation and keep it within 3 to 6. This interest rate, which we are discussing today in length, is the tool through which these ratios are maintained. Once the repo rate increases, the cost of borrowing for business increases, lowering down the investment and cash flow in the market. On the other hand, in case of liquidity crunch in the economy, RBI reduces the repo rate, following which the cost of borrowing also goes down, increasing the cash flow in the economy. Friends, we will also have to discuss the reverse repo rates. We have discussed repo. We'll now discuss what exactly is reverse repo. Reverse repo is a short-term agreement to purchase securities in order to sell them back at a slightly higher price. Repos and reverse repos are used for short-term borrowing and lending, often overnight. Central bank, as I submitted, use reverse repos to add money to the money supply via open market operations. Reverse repo rate is defined as the rate at which RBI borrows money from banks. It sucks liquidity when there is huge inflation. So when a lot of money will be chasing few products, then RBI uses this reverse repo weapon to suck money. The reverse repo rate helps RBI get money from the banks when it needs. In return, the RBI offers attractive interest rates. These days, it is ranging between 3.35%. A higher repo rate helps retain excess liquidity from the market, whereas a higher repo rate helps inject liquidity, whereas a low reverse repo rate will help inject liquidity into the market. The repo rate is always higher than the reverse repo rate. That is a fact all of us know. And repo rate is used to control inflation, and reverse repo rate is used to control money supply. Current rate is 3.35%. While reaching the LIBOR and SOFR, we'll also have to study what is MCLR. Friends, Reserve Bank of India sets a fixed internal reference rate for banks in India. This interest rate is used by banks and lending institutions that come under the RBI tutelage to define the minimum interest rate applicable on different loan types. Earlier, you would have seen in banking, there were no ethics. We were giving loans at 3 or 4 or 5%, irrespective of the cost of our funds, to very big corporates. Say 1,000 crore we'll give to a big corporate at say 6%, even though our cost would be 7%. Why we were doing this? Because we were ensured of return of the money, return of the interest, and bulk usage. One customer only 1,000 crore he has borrowed, so we don't have to follow many. But then that was creating a very bad precedent in the financial market. So RBI implemented MCLR on 1st April 2016 to determine rates of interest for loans. The rate is updated by RBI every once in a while when there is a drastic change in the country's economic activities. Banks are usually not allowed to lend money at a rate below this reference rate called MCLR. Marginal cost of funds-based lending rate, that is MCLR, is the minimum rate lending rate below which a bank is now not permitted to lend. After the implementation of MCLR, the interest rates are determined as per the relative risk factors. Previously, when RBI reduced the repo rates, banks took a long time to reflect it in the lending rates to the borrower. The transmission was very, very slow, and people were not getting the benefit of government's policies. But under the MCLR regime, banks must adjust their interest rate as soon as the repo rate changes. The implementation aims at improving the openness in the structure followed by banks to calculate interest rate on advances. Friends, MCLR ensures the prospect of bank credits at the interest rate that is true to the consumers as well as banks. I submitted in the beginning that MCLR is calculated on the basis of 4 components, that is the marginal cost of funds, CRR, tenure premium, and operating cost. All these, were also there in LIBOR, but LIBOR fudged these figures and got hoisted and removed from the economic system. While rushing through the interest rate in India, I'll also touch on EBLR. EBLR is also mostly like SOFR internationally. There are a lot of good features in EBLR, which are more or less similar to SOFR. Now, RBI introduced the external benchmark linked lending rate in October 19. It's a very comparatively new thing. It is linked to repo rate of RBI. All floating rate loans to micro, small and medium enterprises, that is MSMEs, have been linked to external benchmark-based lending rate by the State Bank of India with effect from 1st October 19. And it is ranging from 8.05% to lower than 7.80. In short, it is the base rate and the minimum interest rate below which a bank cannot lend. The key point here to remember is that base rate is determined by the average cost of funds, in contrast to MCLR that depends on the current cost of funds. So this is a scenario more or less like a comparison between LIBOR and SOFR. Friends, now we come to the darling of the subject, the topic of the day, LIBOR. LIBOR is widely used benchmark for short-term interest rates. We all know the current LIBOR methodology uses input data provided by LIBOR panel banks called contributor banks. It produces a representative rate at which international markets, conducting wholesale, unsecured funding, they fund themselves and in various currencies. It was being quoted in 5 currencies, that is USD, GBP, Euro, CHF, and Japanese yen for 7 tenures in respect of each currency. And those tenures were overnight, that is spot next, 1 week, 2 weeks, 1 month, 2 months, 3 months, 6 months, and 12 months. And the options were so many. When you were entering into an import transaction or an export transaction and were assured of the timeline within which the payment will come or will have to be paid, then you were going for 1 week, 1 month, 2 months, 3 months, 6 months, and 12 months of hedging, so that whatever LIBOR rate was given to you on that particular day was sustained over that period of time. Of course, there was a premium paid for protecting that LIBOR interest rate, but then it was working very fine. The results, in the publication of 35 individual rates for one for each currency and tenor combination was being published, in London every business day. And unfortunately, all this will vanish soon. Why the world needs LIBOR? Why we are discussing LIBOR? Let it go. But then why it needs is because LIBOR is the benchmark interest rate in which international monetary contracts were written. And, the contracts were in trillions. The last count, 3.5 trillion worth of contracts are still written in LIBOR. And it is uniform across the world. The best was that any country in the world knew the cost of fund when he is importing or exporting. Removing LIBOR with local benchmark interest rate shall evaporate the uniformity in value of contracts. Now, because of these 5 currencies, being quoted worldwide and quoting different type of rates, now there will be confusion in the market for some time. LIBOR captures the health of economy by going up and down as per the availability of money supply. See, this is the difference between SOFR and LIBOR. SOFR is based on actual transactions which have happened. So its rate is derived from what has happened. LIBOR was capturing what might happen. So it was, very dynamic type of rate of interest, which used to capture the health of economy by going up and down. And by seeing the LIBOR going up and down, you could gauge the position of availability of that particular currency, mostly dollars, in the international market. A rising LIBOR has been making loans more expensive. Obviously, a lower LIBOR reduces the cost of living. LIBOR is embedded in the business model of international firms. Transitioning to alternative rates is disrupting the business models. The transition will affect how contracts are priced and how pricing risks are managed. Contractual fallback provisions in existing transactions may put businesses at risk of economic value transfer or contract frustration. There might be some contract frustration also, and people are expecting, especially the large banks are expecting, a lot of litigation once the contracts are rewritten, because the cost of funding may go up to many. Now, what was it used for? It was a reference rate used in debts, bonds, derivatives, loan documentation. It is used in a range of consumer lending instruments such as mortgages, even student loans. It is also used as a gauge of market expectations regarding central bank interest rates and liquidity premiums in the money market. It is an indicator of the health of banking system also, whether banks have funds to give. The moment you see LIBOR in a particular currency, you will find out that that particular country is having either cash flow mismatches or cash flow excesses. How it was calculated? Friends, lenders, including banks and other financial institutions, use LIBOR as a benchmark reference for determining interest rates for various debt instruments. It is used as a benchmark rate for mortgages, corporate loans, government bonds, credit cards, and student loans. It is administered by Intercontinental Exchange, which takes the opinion of major global banks how much they would charge other banks if they were to borrow for short-term loans. The rate is calculated using a standard transaction-based data-driven layered method. This is where the estimation thing comes. This is calculated on future events, which might or may not happen. So suppose you are fearing an election in US and not certain of which government will come. The LIBOR will be, reacting very, very strangely. It will be very volatile. Suppose a war is there, or sanctions are on a particular country, or oil production goes down, there's a fire in some big oil refinery, then LIBOR will give you what is happening in international market vis-a-vis foreign currency availability. Lenders use the following formula, that is principal into LIBOR rate into 100 into actual number of days divided by 360 to find out the LIBOR rate. The benefits of LIBOR were many. The London Interbank Offered Rate has been the world's key reference rate for finance transactions since 1960s. It has been ruling for almost 71 years. It is used in trillions of dollars worth of transactions, estimated at 400 US trillion, and loans worth of loans and derivatives, favorable terms and transparent rate structure. It was very, very, there was a LIBOR screen which used to be there, you could find out. But problem happened that the components of LIBOR, they were fudged up and managed by some greedy banks for years together. And that made it, otherwise it was very visible and you could easily log into that, take some forward, enter into a transaction, and it was universally accepted. There was a possibility to benefit from falling interest rates also. When LIBOR used to fall, say it is coming below 1, then you can enter into forward or future transactions. It used to indicate you opportunities also. Now those benefits are gone, and there was optional safeguarding against, of course, rising interest rates. Why it is being removed, I have already submitted. It's a pity that a few greedy bankers brought an inglorious end to an internationally accepted index of pricing finance cost. It is further painful. This is what the message today is, that it is further painful that the benchmark is being binned and removed much before accrediting a suitable replacement pricing tool. There are so many now benchmarks, country wise, currency wise, which are rising. I will tell you in the end slide, even SOFR is being reviewed whether it will continue as a replacement of LIBOR. That is the irony, which is the uncertainty which is facing the international market, being decided by a close group of bankers. In London, LIBOR was being first to enhance profits for participating banks. Overhiked costs were loaded for many years, extracting undue benefit by using cooked up LIBOR. Bankers involved in fiddling LIBOR were dismissed and arrested. And in view of its vulnerability to misuse, LIBOR is being removed forever from banking system 2 days ago. There are a lot of disadvantages. Let's discuss some of them. Most worrying dilemma is the ostentatious cost of replacing the LIBOR. Now, millions of dollars are spent to pay to lawyers to redraft the agreements. All that cost will ultimately have to be borne by customer. There will be transaction costs, there will be processing fees, there will be some charges for refixing this. So all that will unnecessarily increase the cost of living, cost of imports, cost of exports. Untangling trillions of dollars worth of loans and other financial contracts from LIBOR is a very complex, and as I submitted, an expensive and time-consuming process. Your attention is diverted in doing only this. You can't do fresh trades, fresh business. And finance giants looking for cost-effective methods are turning to artificial intelligence to simplify and speed up, so that there is a lot of saving of human effort, human lawyers who might enter into long drawn-out battles due to escalation in pricing. Morgan Stanley has saved legal staffers 50,000 hours of work and 10 million in attorney fees by using robo-LIBOR lawyers. They've created robo-LIBOR lawyers. Robos have been fed with the legal knowledge about refixing LIBOR, and those are doing, because the number of contracts are so many that human beings cannot do. So imagine the cost which is being incurred. So this is a big disadvantage of losing LIBOR. Even Goldman Sachs found computer algorithms doing great things, and ultimately all this cost is going to be passed on to us. There are advantages also. If we are losing LIBOR, we are gaining also something. International banks are concerned that restricting LIBOR-linked contracts prematurely could result in a fragmentation of markets. But there is a light at the end of tunnel as new benchmark indexes emerge. Various countries will develop own treasuries, own domain experts to create interest rate indexes of their own. New experts will emerge. A new interest benchmark will make bankers revisit the pricing. See, once you disseminate, then you will discover that probably the London-based banks, they were charging something which was not justified also. The local index shall capture the true cost of credit also. See, if they are developed in, say, in sterling in London, then they will not bother about what is happening in US market or in the Switzerland market. So they will focus on the local, local cost of funds. So probably they will be able to capture the immediate ambience more effectively once new benchmark rate is evolved. The cost may come down in a few economies where international loans have low volumes. In fact, all of you know, SOFR is less costly than LIBOR. If you compare, maturity to maturity, say a week, 30 days, 60 days, 90 days, 180 days, or 1 year SOFR with LIBOR, you will find that SOFR is less costly. So if you exclude the cost of rewriting contracts, once it is met and contracts are probably SOFR may be cheaper. But there is a catch here. SOFR components, if you analyze, they do not capture the credit default risk premium. That is one thing which LIBOR had, because LIBOR was futuristic and was unsecured. So it was loading in its cost the cost of credit defaults. But SOFR is based on secured transactions, people taking loans from regulator against a surrender and pledge of their treasury bills. So there is no risk there. So there is no risk premium. So that is one difference, which of course international market will shortly sort out. But apple to apple, if you compare, SOFR is less costlier than LIBOR. Now let us see what all the regulators worldwide are doing. The Hong Kong Monetary Authority reluctantly ordered that new product issuance in LIBOR can cease by year-end. They were very reluctant to do that. Singapore has announced a new timeline for its transition to Singapore overnight rate average SORA as the alternative interest rate benchmark at the end of September 21 itself. Some international banks have highlighted difficulties in offering products which reference alternative RFRs, as they are not yet widely available nor published in forex market. Indian regulator RBI has issued an advisory to banks to cease writing new contracts that use LIBOR as the reference rates. They are advised to adopt any ARR, that is alternative reference rate, at the earliest, but not later than 31st December 2021. Let us see what would be the life of a financial dealer or an import and export expert sitting in our treasury once LIBOR goes. Banks across the world are spending fortunes in harnessing artificial intelligence to synchronize LIBOR contracts within given timelines. The number of contracts involved during transition cannot be done by human beings by any imagination. All this is happening because a decade ago, major banks were caught rigging LIBOR. This self-goal done by bankers will bring in transparency now, and it will bring in some integrity in fixing interest rates. Friends, banking is a service industry and it should serve the customer first. And we should not start serving ourselves first. If that happens, then this is what happens, what has happened to LIBOR. Perhaps LIBOR sacrifice would be a new game changer, making more transparency, integrity in banking system. Now we come to the developments which are happening. What will substitute LIBOR? Now, funny names like Honia, Tonia, Unia, Sonia are vying, for occupying the space vacated by LIBOR. The fastest emerging popular alternative is SOFR, that is called as secured overnight financing rate. It is based on transactions in the treasury repurchase market. It's preferred to LIBOR since it's based on data from observable transactions rather than an estimated borrowing rates, wherein LIBOR was interactive. Going by the number of forex contracts written by State Bank of India, Axis Bank, and ICICI Bank, SOFR is widely expected to be used as the new benchmark in India, replacing LIBOR. SOFR is derived from a large volume of real observable transactions, and they are considered risk-free. So here, before we enter into 3-4 more slides, we will bid bye-bye to LIBOR forever, and we now welcome SOFR. What is the difference between LIBOR and SOFR? LIBOR is unsecured rate I submitted based on estimation. SOFR is secured rate based on actual treasury dealings happening. LIBOR has various maturities. Like, I submitted, it is overnight, 1 week, 1 month, 92 months, 90 days, 180 days, and 1 year. SOFR was primarily an overnight rate. You see, SOFR started in 2018 and was very active from 2019 onwards, but it was basically an overnight. Now it is being extended to 30, 60, 90, 180 days. 1 year quotes are also available, but irony is that the practice is still to stabilize. Now, when I ask for a quote for SOFR 30 days, what dealers are doing, they are totaling daily rate of SOFR. So in a month, suppose working days were 20, then they will write daily 20, total them, work, divide by 20, and then give me a monthly rate. Similarly, for 60 days, they are calculating. So this way, the benefit of entering into a contract for long term or paying premium for 30, 60, 90 days is not benefiting me as a dealer. So there is a still a stopgap arrangement in calculating SOFR. LIBOR has a built-in credit risk component. As I submitted, LIBOR always carried a small component of credit risk because it was depending on what may happen. SOFR is risk-free rate because it is based on what has happened. So it has that benefit of hindsight. In treasury market, at what rate banks have taken loan from the regulator, it based on that. So LIBOR is based on estimate. SOFR is transaction based. And as I submitted, SOFR is lower than LIBOR. UK and US regulators have dispensed with the use of LIBOR from 31st till 21. Alternate Reference Rate Committee, that is ARRC, a group of private market participants convened by US regulator, has recommended finally to the US regulator to go for SOFR as replacement of LIBOR. Now let us welcome it. Once the US authorities, whose dollar will be priced in SOFR, have accepted it, let's welcome. SOFR will be fully implemented by 30th June 2023 only, because till that time, the existing LIBOR contracts are valid. They are all long-term and they will be phased out by that time. SOFR is based on transactions in the treasury repurchase markets where investors offer bank overnight loans backed by their bond assets. SOFR is secured rate based on transactions that involve collateral in the form of treasury bills. So there is no credit risk premium baked into these rates. Main difference between LIBOR and SOFR is how rates are produced. That is the, once you enter into the intricacies, how the rates are made, you will find out some revealing features. Now, LIBOR is based on panel bank input. We know, there were large, big banks. So they were, those called as panel banks. They were telling the cost of fund, and this is the rate at which we may borrow from international market from other banks. So that rate was taken as base. SOFR is broad measure of cost of borrowing cash overnight, collateralized by US Treasury securities in the repo market. Will SOFR survive for long? This is a very, very, disturbing question, because if again we write millions of contracts in SOFR, will it survive? Friends, SOFR is produced by the New York Fed in cooperation with the Office of Finance Research. You all know. New York Fed published SOFR each business day at 8 a.m. on New York time on its website. Using real trades, rather a trimmed mean of bankers' forecast, makes SOFR much less stable than LIBOR. That is the irony. It is much less stable. Such volatility could add uncertainty or extra risk on SOFR contracts based on risk aversion from getting a higher daily rate. SOFR matches the term structure and forward-looking features of LIBOR, but it does not match the credit risk-sensitive nature of LIBOR. That is the irony. See, entire credit is managed on risk perception, and that is what is missing in SOFR. So it is likely that a credit rate sensitive rate may emerge as alternative in times to come to SOFR. Friends, we have discussed evolution of banking, evolution of financial markets, concept of interest, compounding interest, other items of collecting fee. We've also discussed repo and reverse repo, MCLR, EBLR. We dwelt at length about the disadvantages, advantages of LIBOR. We welcomed SOFR and bid goodbye to LIBOR, but we are still thirsty of a proper index which will come. Friends, before closing, I need only a few minutes for relating a small story. What happened? There was a guy who used to worship God day in, day out. Every time he was chanting mantras, remembering God, thanking profusely, expressing gratitude that he has been given this life, he's happy, he's preoccupied, he's healthy. So one day, God, appeared before him physically, and he was surprised to see his prayers answered. He fell into the feet of God, and God, blessed him and said what he wants, why he remembers so often. He said, no, he remembers God to thank him for all that has been given to him. God said, okay, I have come here. I want to give you some blessing. You ask for anything you want. But he said, sir, I am satisfied. You have given me everything. I do not need anything. God still insisted. So this guy said, okay, you do one thing, sir. Give me a prerogative. एक मुझे अधिकार दीजिए. God said, what? He said, when I die, give me a prerogative to choose hell or heaven to live. I will decide after my death where I will go. I will go to heaven or hell. God smiled and said, you could have asked for promotion, money, land, jewels, long life, but you have asked for something which is very easy to give. Okay, I will give you. At the time of your death, you can choose to live wherever you want. So at the time of death, Yamraj came and told him to come. He said, where are you taking me? Yamraj said, 99.99% people go to hell because they tell lies, they misbehave, they are not of integrity. So you also come there. Then this guy produced a document where God has given him blessing that he will choose where to go, to heaven or hell. So Yamaraj was surprised. He cross-checked and found that that blessing was true. So he took him. And he said, okay, you see this is hell. When he peeped into hell, he found a table laid with flowers, beautiful, rosewood chairs. There were French windows, carpets, lovely food to eat. He said, is it hell? So beautiful. Yamraj said, yes, it is hell. Then he said, what is heaven? Heaven must be much, much better. He said, there is the heaven. You go and peep there also. So he went there, and to his surprise, he found a similar table, similar flowers laden with the beautiful fruits, food, rosewood chairs, French carpets, French windows, everything, was there. So he was surprised to see both places similar, and asked why people say that hell is bad and heaven is good. Then this Yamaraj said, you see for yourself. Then he found that people started coming and taking chairs both in heaven and hell. In hell, he noticed that their hands, they could not be folded. In heaven also, it could not be folded. They were just sitting across. So in hell, they were trying to eat themselves, pouring food from unfolded hands, which was falling on their, shirts, clothes. They were spoiling the things. And they were feeling very hungry. They were not satisfied. Their, heads were, all fallen. They were very, very sick. He peeped into heaven. He saw that same people are feeding each other. And they are all happy because they cannot band their hands. They are helping each other. So friends, the difference between heaven and hell is cooperation. If we, work together as bankers, share our experiences of LIBOR, SOFR, how it has to be implemented, how we can pass on the benefit to the customer, because India is targeting a $400 billion export target. We have enough resources. but still we want make the India to be a winner in international market as well. So friends, let us cooperate together, share our information, and take the banking industry to new heights under the aegis of Elite Bankers Club. I thank you very much for listening to me patiently. Thank you.
Thank you, Mr. Hargovind Sachdev. It was a very nice presentation, I would say, and you made it very, very interesting, using all those small stories, anecdotes, and it was a beautiful presentation. I enjoyed it very much. And friends, I forgot to mention while I was introducing Mr. Sachdev that he is also a very prolific writer. He is writing many articles. As a matter of fact, he is now a regular contributor to our Bankers Weekly also. And there is a regular column, Finspiration, appearing in his name. And every time he is writing an article on something which is very, very relevant and very current topic for bankers. And Mr. Sachdev has agreed to share the presentation with all the participants. So when I'll be sharing the video with you, I'll also share the presentation with you. And we are also very fortunate to have with us today Mr. Bhaskar Sen, ex-CMD United Bank of India, Dr. Farid Ahmed, ex-ED Punjab and Sindh Bank, and Mr. S.K. Jain, ex-ED Union Bank of India. I'll be also inviting them on stage for their observations on this. I will request them to switch on their videos. In the meantime, I'll have also some announcements to make. That feedback form for this particular session has been shared with you on your email as well as through WhatsApp. Please send your feedback. It will help us improve ourselves. The calendar for webinars for January to March has already been shared with you. And please mark your calendar so that you are able to attend all the webinars. And many members have already extended their membership till 2023, taking advantage of the festival discount that we were offering. So looking to the response, I had decided to extend that festival discount by one more week. So members who want to extend the tenure of their membership by 1 year using that discount can do so within the next 1 week. And we are also starting a second batch sometime in January, as soon as we have the sufficient number of participants. And I request you all to send references of your friends and colleagues who might be interested in joining the club. And also request you to follow up with them, follow up with the references which you have already shared. Now I'll request Bhaskar Sen sir and Mr. Farid Ahmed and Jain sir to please share the stage. I am putting the spotlight on them. So now they are visible to everybody. Jain sir, आपने अभी share on नहीं किया video, please on कर लीजिए. And I'll start with Shri Bhaskar Sen. He is actually a doyen of foreign exchange. When I was a new entrant in bank, I heard his name that we have one Mr. Bhaskar Sen who is an authority on foreign exchange. So we are very fortunate to have him here today, and I'll start with his comments.
Thank you, Mr. Arvind. And thank you, Mr. Sachdev. It was a very nice presentation. Am I audible? Can you hear me?
Yes, sir. Perfect.
Yeah. So thank you very much, Mr. Sachdev. So it was a very nice presentation, and you have explained the whole thing without confusing anybody. So that's the beauty of it. I have a couple of questions for you. Now that we are in a transition period, how we're going to manage ourselves? I mean, we're talking about Indian bankers. Is there any directive from Reserve Bank of India how to manage the situation? And my sense is this transition period is going to be very painful for everybody and particularly for us, as it is, we have not many problems. So that is my
We are
first
in
question.
most import-based economy, so we'll have a lot of problems, rightly said.
Yeah. So that is my first question. And my second question is, two benchmarks. Of course, I am not updated on this. I'm out of touch for a number of years. Two major benchmarks were evolving in India. One is MIBOR, the other one is MIFOR. What happens to them? They are still continuing, or the same fate as it happened to LIBOR, the same fate is awaiting them? Or some other benchmarks are evolving in India? So these are my two questions for you.
Thank you, sir. I'm really a student of yours, and a guru asking a student is the greatest honor ever given. I had also the fortunate of becoming CEO of United Bank of India in 2016. So every wall, not to say of every employee, they used to praise you for giving your leadership, which you gave to them, and brought the bank to pinnacles of glory. Regarding your question, sir, RBI has said you go for alternative, but given the contracts written by SBI, ICICI, Axis Bank, HDFC Bank, SOFR, because it is most of our import and export is in dollars. Our foreign exchange assets are all in US. So we have opted for SOFR. And we are likely to continue. But as I had submitted in my deliberations, that it does not contain the risk premium. It is cheaper. So probably, if some big losses come, suppose we are importing aircrafts for defense from France, and we cover it under SOFR and rate volatiles, problem maybe there we may look, but there is no alternative available right now. So SOFR is the in thing given by the contracts we have written. Regarding MIBOR, MIFOR, they have restricted applicability after MCLR came. So all banks have shifted to MCLR and EBLR. So the MIFOR are there, if you're doing some term loan conversion into a long-term derivative, then MIFOR plus some margins are used. But basically, everything is coming under MCLR now, sir.
So, Dr. Farid?
Thank you, Mr. Sazdev.
Good morning, everybody. Argoinji, it is an excellent presentation on LIBOR, and in fact, you have given an evolution of interest rates, how and banking, financial markets, and leading to the today's topic, LIBOR. As Bhaskar Senji has said, during the transition, definitely as the country is mostly depending upon imports, or imports are more than the exports, it will cause some problems. But some of the countries are facing, I think, but I don't know about exactly our income tax rules. But UK and all other countries expressed that it will have impact on their income tax. Anything about Indian taxation? Impact of withdrawal from the LIBOR, whether it will have anything?
Yeah, certainly, sir. It is cheaper. It will cheaper, and then it is slightly uncertain. If you take the insurance on credit risk, then you spend there. Being cheaper, your profits will zoom up. So income tax angle will be there. But ultimately, they will end up insuring their invoices or contracts with the insurance agency. And they will also be, paying for SOFR, even though it will be cheaper than LIBOR, but ultimately being cheaper, it will end up in paying taxes.
So I should appreciate, I'm going through your all articles, and they are very enlightening and knowledgeable, both in Bankers Weekly and also LinkedIn, and try to continue so that we can gain something from your very good knowledge in the exports and other international banking and other areas. Thank you.
Yesterday, we were sitting doing some forensic audit of Punjab Sind Bank. The amount of praise they said, you know, as an executive director, changed the, you know, ethos of that great institution. They really missed you. I'm telling you from a very senior guy who was recollecting your days there, the, you know, the qualities which you bestowed on them of self-confidence. You know, it was a struggling bank, and you brought it to that shape, sir. Thank you very much.
Thank you very much.
As a matter of fact, Dr. Farid has been very, very instrumental in shaping up this club also.
Oh.
Many ideas are coming from him, how we should proceed further, what kind of topics we need to have, and what new initiatives we should be taking. So he is very, very instrumental in giving shape to this club also. And we are all very much guided by him. And now the participants, if you want to ask questions, please switch on your video. I'll bring you on this stage and you can ask the question.
Good afternoon, sir. Yes, good afternoon, sir. First of all, my best wishes for the new year. Very happy new year to all of you, sir, respected sirs. It is really, it was really very excellent session, sir, today, right from the evolution of banking and evolution of rates and all those things. Okay, we are seeing many rates were there since beginning itself, PLR, BPLR, then base rate, MCLR, EBLR. Now the international market, LIBOR has the reign over more than 61 years. Just one question, sir, regarding the cryptocurrency on all. You have told now it will be a cheaper one, SOFR, it will be cheaper than the LIBOR. Whether somewhere, I don't know, I think, foreign banking, I don't know about the forex and all those things, that I am poor about that. But whether any impact will be there in the rates if the cryptocurrency is there?
Very interesting question, sir. Actually, cryptocurrency is on blockchain, and it is very transparent, and there is not you know, much of turbulence, although the rates are determined by demand and supply. A lot of craze is there, so rates are going up. Sometimes the international events are bringing the rate down, but then SOFR, LIBOR will not have anything, because nobody does a forward contract to purchase cryptocurrency or sell it. So they are on a different path. But ultimately, as you said, if our India's RBI is also bringing our own cryptocurrency, the deputy governor is on record to say that they are studying, and it will come as a fiat currency. So once that comes, then that will bring in the SOFR and other local benchmarks to cover it forward. Probably at this stage, the 6,000 odd cryptocurrencies which are in market are not attracting SOFR or LIBOR.
Thank you, sir. Thank you so much, sir. Actually, I am always going through, just Farid sir mentioned that your article in the LinkedIn as well as in Bankers, Bankers Weekly also. So it is good to have it, sir. Thank you so much, sir. Thank you very much.
Thanks, Rishikesh ji. Now we have Mr. Shankar Narayan. So
Good morning, sir, and Happy New Year to all of you. And I had the privilege of working with Mr. Sachdev. We were in the same bank earlier before merger with SBI. And I had a lot of good experiences with sir also. Of course, we have not worked together in office, but I have heard about all his laurels and credentials in our bank. And today's session was very thought-provoking and very highly informative. I really placed on my record the good experiences we could share from Mr. Sachdev. So since I am working as a head of market risk management and ALM in Catholic Syrian Bank, CSP Bank, after my service in State Bank of India. So one thing, sir, the session, as far as practical bankers are concerned, the pricing methodology will be of much use to the bankers. So in the next session, probably we have put in place how to price the product under the new scenario, that is going from 3rd of January 2022. Many banks will have keeping their fingers crossed as to how the products are to be priced. This is one of the major challenges many banks are facing. So each one following so many things. At the outset, for the kind as a clue, what we are now doing is, since the cost of funds are already in LIBOR and margins are marked for the asset side from the LIBOR tenor, appropriate tenor LIBOR plus the markup, many banks are switching, replacing it the terms for appropriate tenor plus the difference in the markup. So that is how the pricing is going on in the market. This is one thing that has evolved. And MY4 and MY4 two MY4 rates and MY4 adjusted rates also in the market, one for legacy and one for new contract. That has also been developed by RBA. That is another recent development that has happened. So the pricing is a challenge. Of course, as far as legal contracts are also another area. More above that, technological inputs as to how our existing system has to change. This is another challenge for many banks. Of course, other factors are legal, reputational, all those risks, etc. So my suggestion would be that how the pricing followed in many banks, how if we can collate and bring us a common platform, it will be helpful both for the banking community and for us also. That's my request, sir. And other than that, session be enjoyed.
Thank you, Shankar Narayanji. We will dwell at length, maybe bilaterally, on how it is to be priced. I briefly touched how 30 days SOFR is being calculated nowadays. They're taking average of the daily and then totaling and then dividing by the number of days it is quoted. So it's in a very preliminary stage. As you rightly said, apart from legal and financial aspect, it has technological effects also. And once the technology is put in place, like we had for LIBOR, LIBOR, you have to just enter a few data and screen it. System was automatically giving the forward LIBOR rates. So similarly, SOFR also from tomorrow onwards, people will invest in technology and will come out. We can have a session, if Mohanji says, on how to fix 1 month, 60 days, 90 days SOFR in the days to come. It's a very interesting topic, and this will remain a very hotly discussed subject for many, many months to come till it stabilizes.
You permitted one more question, sir. This term so far is the current practice of using getting used in the market, immediate substitute in place of LIBORs of various tenors. So what is your take? Whether, because ultimate take on all the Financial Conduct Authority says that overnight rates compounded daily in arrears. That is the policy that so that is
how it is done, because it's basically designed for overnight, because the treasury bills, no bank will keep for months with RBI. It's all done for very short tenures. So it was basically designed for that, but then everything evolves as per the requirement of the world trade, and this will also stabilize.
So liquidity also has to evolve along with that. Otherwise,
very true.
The liquidity premium also has to be part of the component.
That is what is missing in SOFR. That is what is worrying us who are practicing this, interest rate mechanism. That if you do not price risk mechanism and give a product without that at a cheaper rate, people will fall for it. Dr. Freed was worried about the income tax. Now you said you translate this contract into SOFR from LIBOR, and then being cheaper, you save some money. Income tax fellows tell that you have contracted for this, earned this much, saved this much. So a lot of issues are going to come. But then, market will take care of this.
No, that margin is now getting adjusted in the already LIBOR-based pricing. So they are doing that. So
how income tax authorities will understand that, whether it is getting adjusted. He'll say you are saving more.
It is adjusted. They don't want to lose it. That many banks have taken a call.
That is the issue, sir. That is where income tax issues are confronting banking authorities like Mr. Freed, because this is a interpretation. How income tax people will be trained into this, and how they will infer is all questionable.
Yes, thank you very much, sir. Thank you very much, sir.
Thanks, Mr. Shankar Narayan, for those very insightful questions, and also giving us an idea of a new webinar topic. And I'll talk to Mr. Sajdev as to how and when we can organize that. Now, it's great to have with us Mr. Anil Bansal, former Executive Director of Indian Overseas Bank, and just like my elder brother, always with me, always supporting me. So I'll request him for some words on this session.
Arvindji, let me congratulate you that you made a humble beginning by bringing Arvind. I heard him for the first time. Phenomenal, awesome. These are the words coming out of my heart for him. A very difficult topic for the current time, and he explained it in a very beautiful manner. Although I'm not a forex man, but my anxiety was to understand and know how things will work out in the future time. So let me compliment Mr. Arvind and also Mr. Hargovind for this wonderful. And I'm reconnecting after a long time. So enjoyed watching the entire episode today. All my good wishes to everybody.
Thank you, sir. Thanks for your blessings and your support. And I don't see any more questions coming. So we are coming to the end of this session. Next session will be on risk management on next Sunday itself. And it is actually a special session we have organized. Otherwise, we have every alternate Sunday. But we had earlier 2 sessions on risk management, and I felt the need to supplement what was discussed in that within another session. And I requested Dr. Farid, and he'll be taking that session on 9th of January. And I'll request the participants to note the change in timing. Normally we meet at 11, but on that day we'll be meeting at 10:30. So there is a slight change in timing. So please take note of that, and do join us at 10:30 on 9th of January, on what is again a very important topic for all of us, risk management. And we have added to it how it can be used to conserve the capital of a bank. So these are very important things, particularly for those at the senior level. So with that, I end this session today. I thank Mr. Sajdev for having taken this session in a marvelous manner, very interesting manner. And Sajdev sir, if you agree, I would request you to join our club of members. If you agree, I will add you to that group, and so that other group members, you will be in regular interaction with all of them through the group. And now I thank everybody. Thank you all. Wish you a very, very happy new year again. Thanks. Namaskar. Thank you, sir.